Someone who invests $200 every month walks away 30 years later with more than 11 times what they originally put in. No luck, no special knowledge required. That number is not speculation. It is the calculated output of a market index that has averaged 10% annual returns every single year since 1928. But behind that calculation sits a mechanism most people were never shown, and that mechanism does not simply grow money, it causes money to multiply itself. That mechanism is called compound interest, and its defining property is that previous gains generate new gains, meaning the portfolio itself works harder with every single year that passes. A single dollar invested at age 25 becomes $45 by age 65 with zero additional contributions, powered entirely by the compounding effect alone. That same dollar invested at age 35 becomes only $17 by 65, a difference of $28 produced by nothing more than a single decade of delay. This is not just a number comparison. It means that someone who starts at 35 can never run fast enough to fully close the gap that one lost decade created. Someone who invests $200 a month starting at 25 finishes with $140,000 more than someone investing $1,000 a month starting at 45. The second person contributed 5 times more per month for 20 years, yet the first person's returns compounded so much longer that mathematics turned decisively against the second person. The strategy that captures this outcome has a name. It is called dollar cost averaging, a rule formally analyzed by economist Paul Samuelson in 1969. The strategy has exactly one requirement. Every month, regardless of market conditions, a fixed amount is placed into the same broad index fund without interruption and without exception. When prices fall, your $200 automatically buys more shares. When prices rise, it buys fewer, which means your average cost per share always stays below the average price. The name of this mathematical advantage is the harmonic mean effect, not an opinion or a financial advisor claim, but a proven mathematical property that operates identically across every investment period. Now, the most important question is this: why do most people fail to use this rule even when they know it? And the answer is not found in mathematics, but in psychology. Kahneman and Tversky proved in 1979 that the human brain experiences the pain of a financial loss 2.5 times more intensely than the pleasure of an equivalent gain. This means a $100 drop in your portfolio is psychologically felt more than twice as powerfully as a $100 gain, a documented bias called myopic loss aversion. Myopic loss aversion forces the investor to evaluate performance over weeks instead of decades, and when markets fall, it generates an impulse to abandon the entire strategy immediately. Investors who paused contributions during the 2008 crisis permanently surrendered the opportunity to buy shares at 60% below their peak prices. By 2013, those same shares had tripled in value, meaning those who exited absorbed the full damage of the crash and missed the entire recovery simultaneously. Behavioral research consistently shows that investors who automate fixed monthly contributions maintain their strategy at significantly higher rates than those who make manual contribution decisions each month. That behavioral gap compounds over 40 years into a portfolio difference measured in hundreds of thousands of dollars, generated not from market returns but purely from consistency alone. Automation is so critical to this rule precisely because it eliminates the human decision point entirely, meaning there is no moment of fear to act on when markets decline. Fee structure determines how much of this compounding you actually keep, and the average actively managed fund charges 1.1% annually against your returns. Broad index funds charge only 0.03% annually, a difference that sounds trivial but creates a $240,000 gap on a 40-year, $200 monthly plan. Independent index research confirms that more than 85% of actively managed funds underperform their benchmark index after fees across any rolling 20-year period. Active funds also generate taxable events through frequent trading, which reduces real after-tax compounding by an additional estimated 0.5% annually, a figure that grows substantially over decades. Researcher Richard Thaler proved in 1982 that money set aside on payday before any spending occurs behaves behaviorally and structurally differently from money saved after spending. This mechanism is called paying yourself first, and investors who automate contributions on payday accumulate on average 340% more than those who invest whatever remains at month end. There is a threshold researchers call passive velocity, the moment when your portfolio generates more annual growth than your new contributions, reached at approximately year 22 on a $200 monthly plan. After year 30, your monthly contributions represent less than 15% of total annual portfolio growth, meaning the system sustains itself predominantly on its own accumulated capital. In simple numbers, $200 per month invested at 10% annually for 40 years produces a terminal value of $1,100,000. Total contributions across that entire period equal only $96,000, meaning everything above that figure was generated purely by compounding, not by the money you deposited. Federal Reserve data shows the average American household spends more than $400 monthly on non-essential goods, meaning this strategy has no income problem, only a priority problem. The problem is not earnings, it is consistency, not emotion. It is system, not market crashes. It is the absence of a mechanism that keeps running automatically through those exact crashes. 3 things are required to implement the system: a brokerage account, a broad index fund with an expense ratio below 0.1%, and an automatic monthly transfer tied to payday. No market forecasting is required, no individual stock selection is required, no deep knowledge of economic cycles is required, only the system is required. 92% of people retire with less than $1 million, not because they lacked $200, but because they had no system running automatically during the months markets were falling. That system has one name: dollar cost averaging, a mechanism 40 years proven, built on the intersection of psychology, mathematics, and automation working simultaneously. You can build this today. If you are 25, you have time. If you are 35, you are not late. But every month that passes does not return that portion of the time premium. Subscribe to FinXRF's Finance, because this channel teaches mechanisms exactly like this one, not motivation, never motivation, only the rules that actually determine financial outcomes.